Loving the Smart Property Investment Show? Then you're going to love tuning in every Monday to the Scouting Australia podcast, hosted by Sam Gordon, Smart Property Investment Show's most downloaded guest.
That always just triggers in my mind. Like I'm always wanting to look after people because of what happened to me there.
What are you waiting for? Listen to the pros at the Scouting Australia podcast, now on all your streaming platforms, and get educated.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. I hope you're well wherever you're listening to this on the Marvels. That is the podcast network, the Property Investment Podcast Network, wherever you get your podcasts, or on the internet, on the video, on the YouTube, embedded all over the joint. Welcome. Thanks for tuning in at Smart Property Investment Show. One of the highlights of my week is coming on, having a yarn about property, particularly when it's moving and changing so much and everyone's sort of always worried and concerned about what it all means, and they're trying to uncover the next big thing and overanalyze and overinterpret everything that's going on. And we're certainly in one of those markets right now. It's on the tips of everyone's tongue, property, particularly when the Reserve Bank has decided to take a bit of a rest in April from hiking up interest rates now. A lot of economic commentators pretty fast out of the block saying, yeah, that's it. There's no more. I'm still 50-50. I reckon there still might be one in it. I've sort of spoken a little bit about that beforehand. But I do note that the Reserve Bank governor has come out saying, hey, everyone just relax. There's probably going to be more. We're just going to wait and see what happens, this impact from this latest rate announcement. So anyway, it's going to give us lots of commentary to talk about over the next few months, how that's going to pan out, a bit of a breather, see how much the impact of these increases to mortgage rates are curbing consumer spending and the sentiment connected with it. But we like to talk about these things on the Smart Property Investment Show. That's why we do it. It's good fun, and it's one of those things that I try and get the narrative right each and every time to help steer more informed investment decisions from you all. And I hope things are going well. And we're sort of investing in property, a lot more to come onto that moving forward. But today I wanted to break down, it's a very, very tough market to try and understand what next. Now, there is commentators coming out, and I am not informed enough yet to have my own opinion around it, but talking about the bottom of the Sydney market, for example, and the fact that we've had a number of months of consecutive growth, albeit marginal growth. So some people are calling the bottom of the property market in Sydney, and there's only going to be upsides moving forward, whereas other people are sort of saying, nah, it's a dead cat bounce. It's going to go up again and come back down again. So everyone's got an opinion on this. And the tough thing is, if you are a property investor, how do you actually make a decisive factor in determining how you're going to approach buying property, whether you're going to continue to buy property and whether now's the right time to buy property? Now, on smartpropertyinvestment.com.au, we have our suburb search app where you can go and look at data for 4,000 plus suburbs provided by our good friends over at CoreLogic. A lot of people get obsessed, too absorbed with this information, and it hinders investment making decisions. So I want to break that down today, give a sense for how it all works, what it all means, and how do you actually intersect property data with other stuff that's not property data in making informed investment decisions. Paul Glossop is the CEO of Pure Property Investment, joins me in the studio. Paul, how you going?
Very well, Phil. Very interesting times, mate. We're probably coming into a number of things which, as you've just alluded to, mate, we've got a couple of consecutive months of monthly growth in Sydney. Stable growth. That right?
Yeah,
absolutely.
Yeah. It's like 0.3% or so.
Yeah. It's marginal. Quarterly growth for Sydney was over 1%. And if we look at it from a national standpoint, we're pretty much entering into slightly positive territory. To your point, though, is that because of this most recent pause in the RBA lifting of rates? No, certainly not. That's got nothing to do with that in particular. It's got a lot to do with supply at the moment, but we're also coming into budget territory when it comes to federal budget territory coming into May. We're starting to hear from Jim Chalmers talking a lot more about austerity measures and really tightening the belts when it comes to spends. And the RBA commentary as well is a lot along those lines, is that I think the intention here is to say they don't want the Australian public to really look at this situation and say, great, everything's going to enter back into a growth scenario. We're certainly not there, and I don't think they want people to be perceiving that we're out of the rough of it and we're coming back into fairway territory now. We're certainly not there. So I think the property market is specifically it's very dependent on the particular location.
Are you calling the bottom of the Sydney market?
I personally think that if we're going to draw out a line of saying, hey, and when we say bottom of the Sydney metro market in general, if we look at it from a 3-year horizon and what that line would look like, I think we're probably pretty close, plus or minus 5%.
Okay, so you're sort of down towards the bottom of the dip. And they always, I know there's a lot of logic around this, but they think the way back up is normally faster than the way down. And that's traditionally how it's worked in Sydney or Australian property markets, right?
It has. And I think previously the rebounds have been, they're always driven by something different. The upswings and the downswings are driven by typically a few different things. But the reality is that there's a few different aspects around the Australian property market and specifically the Sydney and Melbourne markets, which are so unique right now. We've got the highest level of interstate and overseas migration specifically that we're probably ever going to see on record.
It's bonkers.
Which, it happened immediately. It's kind of almost like the same time as this interest rate cut started to happen back in 2020. You saw this market move insanely increased as far as the Australian property market. Sydney was obviously taking full benefit of that. And then yields, for the most part, we've gone through 10 years of decreasing or declining value in the actual price. So yields actually haven't gone anywhere. And all of a sudden now you've got all this price increase as far as cash, the cost of cash increase, which means there's less people able to buy property, even if they still want to buy property. And then you've got all this influx of pressure from people coming to want to take on these properties and actually either live in them from a rental perspective or buy them. And then at the same time, you've got no supply. We're down 25% on actual buildings coming to market, and supply doesn't happen in a night, in a day, in a week, in a month, in a quarter. It typically happens over a 2 to 4 year period when you buy a property, design the property, get it approved, build it. So you've got this massive problem because they're trying to fight inflation on one front and you've got the fastest level of rental growth on the other front. But we need these migrants to bring down the pressure on unemployment to then essentially even out where these wage growth positions are going to be. It's an insane market. And I think we're nowhere near the bottom of how this is going to unfold. One thing's for sure, and we've said this a fair few times over the last 12 months, rents will continue to rise. So if you're a tenant, expect that's going to happen. If you're a landlord, I guess the really big benefit of this, and as per the title of this show, the Smart Property Investment Show, yes, we've been coupled with huge amounts of increases in actually holding assets, but that's been coupled with 10, 15, 20% increases in rent. So in a lot of cases, that's coming pretty close to keeping pace with the actual cost of holding the asset. Yeah. And it's usually a bit of a lag as well.
Yeah, and this is when you can tinker with your mortgages as well, right? Like
Absolutely.
If you're P&I, you can reset the interest only, which we're doing at the moment on our smart property stuff, which is good just to try and cover some of the cash burn as a result of rising interest rates. But if you haven't reviewed your rents for some time, get stuck into it. I was reading a story this morning. I don't know, that sort of angers me sometimes. I'm quite keen on your sort of views of it. It was in the Daily Mail, which is a reputable online newspaper. Everyone reads it, right?
Advocate.
Yeah. At least that's entertaining and engaging. But it was a story of a young couple, right? Youngish couple, complaining about just saying, everyone's subscribed to this dream of the great Australian dream of owning your own home, saying it's impossible now. It's impossible now because everything's so expensive. We can't buy a home where we grew up in Warriewood for $2 million.
In Warriewood. For $2 million. It's unfair.
It is unfair. We're giving up.
It's un-Australian.
We're told that we've got to work hard to buy our own home. We've got to work hard and, we're giving up and it's impacting our mental health because we can't afford to buy a home where we want to buy a home.
Mate, look, we could go so far down this channel. Here's a question. Do you know how much your mum paid for her house back when?
Yeah.
And I assume that was, late 70s?
No, 60s.
60s.
68.
68, there you go.
68, yeah.
What was that roughly?
£20,000, I think, by
memory. Yeah. And I know my mum paid $36,000 for her home in the southwest of Sydney, and back 70s. Then it was the fringe. And where your mum bought,
it was the fringe.
It was the fringe.
Yeah.
And where my auntie bought, which was one street behind where my mum bought that house, she bought her house 4 years prior to that for $22,000.
Yeah.
And I thought that $36,000 was an insane amount of money because it was 50% more than what it was 6 years ago. I guess the point to this is that, irrespective, you can draw these parallels, and those same markets, that same house that my mum bought, 40 years ago is worth $1.1 million now. And you look at it from a growth standpoint or a cash on cash turn, it's insane.
Yeah.
it draws probably to your point of what you're seeing doing the rounds, and we're sort of in the middle of April. There's an ABC clip, black and white ABC clip that's doing the rounds of social media, and you would have seen it because the moment you saw it, you thought that is so poignant of what's happening right now. And if anyone hasn't seen it, you'll probably see it if you start Googling this. It'll hit your feed real quick. But to give the crux of it for the listeners. It interviewed what looked like a very young couple in their early 20s coming out of an old school auction room with an ABC interviewer saying, did you buy a block of land? Because it looked like there was probably 40, 50 blocks in some far outreaching suburb of Canberra at the time, essentially going to auction. And their response was, no, too expensive. And then the question followed up saying, what were you prepared to bid? And they said, we had about $1,600 that we were prepared to go to. And then they started to go along saying, they were starting at $2,000 and some ended up going for $3,000 or $4,000. And it interviewed an older, probably more of a 40-year-old guy who said, I picked up one property, we paid $3,400 and they went through the dimensions of the property, etc. And I guess the point with that is...
And he used really funny...
I thought it was actually talking about that horse racing, the lengths, and it was, it was feet and hands and some...
I can't remember what it was.
Yeah, it was interesting because I had to go and Google it straight away. I think, how does that actually work out dimension-wise? But I guess long story short, the reason why the young couple didn't buy is that they genuinely said, look, I don't know what's pushing up the prices. Is it demand? Is it not enough? Because we just think it's insane how much, and the price is a bit irrelevant, but the actual discussion point about what's pushed up those prices at that time, and then 5 years later, 10 years later, here we are in 2023, essentially we're talking, 50
all
years.
The same stuff.
Always the same stuff.
All the same stuff.
Same rhetoric.
But the point being, and we have a lot of younger listeners tune into this on their pathways to sort of property ownership and wealth creation. Be careful who you surround yourself with when you're talking and thinking about property.
Absolutely.
It's a key thing. If your peer group sits around and laments not being able to buy your first home in a multi-million-dollar medium price and complain about your lot in life and how it's really, really hard, it's not really a positive force. And we could say that because this is a show for property investors.
Absolutely.
Right? I reckon there'd be other things where they would be concurring with that and saying it's the government's problem and they need to make property cheaper for everyone. Well, hot tip, it is. You just got to move away from Warri Wood.
Yeah. Or be prepared to rent and invest elsewhere and drop your price point to what you can afford and what your deposit and your savings is going to allow you to get into. And we're both products of saying we started with what we could afford and we built from there.
Yeah. And this is the point around property investment for the purpose of creating wealth through property, not for buying a principal place residence or own occupy a home. Two very different things. But people tuning into this are here to learn about property, how to do it more effectively. And they get, as I mentioned beforehand, obsessed with property data. And I'm sure everyone at some point in time's probably overcooked their investment of time, energy and effort in the property data. So I wanted to break it down a little bit. We're going to get into it. Just we'll go to a quick break. Paul, stay with us. Back in a moment.
This year might just be the right year to invest in property. But before you jump in, do you have a low-rate investment loan pre-approved? It might be the right time to invest, but the wrong loan could dent your prospects for achieving the maximum return. Are you armed with the best finance at the sharpest rate? Find out with Finny. Call us now on 1300 002 023 and find out what you could save. Or visit our website, finny.com.au to book an appointment.
And welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop, CEO over at Pure Property Investment, one of our regular guests on the show. Now, Paul, you guys are in the business of finding properties for people, right? That's what you do?
Absolutely. We're in the business of setting strategies and securing assets. Typically established off-market houses is predominantly 95% of what we do.
And that's being a buyer's agent, property advocate,
correct.
Property strategist.
So we're property strategists and buyer's agents.
Yeah. So you help, what are you going to do? And then you say, this is how to do it. Okay.
Yep.
All right. Simple. So how much, when you're looking at market opportunities for, say someone's got a strategy, whatever the strategy is, right? Yep. It's another podcast. When they go, okay, this is what I want to achieve. And you go, okay, well, right, let's go and find you the right asset in the right location. That right location is going to be a mixture of research. So book research versus going out and having a look around research, like sort of human intelligence versus sort of like information intelligence, whatever you want to call it, right? What's happening on the ground? What information do you have to help shape and persuade where you go looking? So I want to get an understanding of how do you find a location? Do you sort of use data and all this information that you can get from the internet and all these other sources first to try and give you somewhere to focus on? Or do you sort of start focusing on an area and then try and use information to support the decision around it?
It's a really key part of what we have to do on an ongoing basis, to be honest with you, Phil. And the reality is that we typically will always assess that if we don't have two clients who are going to be the same. We'll have budgets that are going to be as low as 300 grand. We'll have budgets which potentially can be infinite, and we can keep going and going and going. And that might dictate saying, hey, we're looking for $1 million plus suburbs, or we're looking for sub 300 grand suburbs. And then from there, as part of that initial strategy part, we might say, hey, we need to get a 5% yield on this to actually get the bank to lend us the money. Or if it's in an SMSF, here's the precursor requirements. Or it might be saying, hey, yield's not the concern here. We're looking for growth and we're looking for a 10-year play, or it might be something in between. So once we've established that, we then go back to that data and that research. So I guess what we have to do is essentially have markets that we are always assessing that are pre-allocated to say, if we have a client who has, for instance, let's say hypothetically, no assets in their portfolio, 70 grand deposit, and they can borrow up to $375,000 for their first purchase, and looking to put a 10% deposit plus all closing costs, and they need it to be, plus or minus potentially up to costing them maybe 2 to 4 grand a year. And that's kind of that avatar. So we need to then say, okay, well, which markets within Australia right now are going to give us best propensity to both grow in value over the next 1 to 3 years, but also look accurate if we're going back to saying, hey, we want to look back on this property in 10 years, 20 years, 30 years, of saying that is a very predictable growth market over that time. And ideally, we want to give that client that leg up advantage immediately to see more than the actual average annual growth in that short period of time, because that gives them the ability to recycle equity quicker and put it into the next investment as well. So data will tell us that information first and foremost. We don't go and look for a particular property in a suburb and go through essentially realestate.com and say sub $400,000, what properties are available in the market. We need to know essentially what our data and research is telling us first and foremost. And then once we know that we've got a client who fits that budget and that yield requirement, we've typically already got probably somewhere between 2 or 3 major metro markets that are the areas in general. And then within that, we'll have half a dozen, potentially up to 10 separate suburbs, which will fit that criteria. And then it goes to us, essentially the ground to truth. That's the rubber meeting the roads, literally on airplanes, knocking on doors, going through open homes, going through off-market inspections to then collate it down to 1 or 2 properties which we know fit the criteria and will fit the budget. Then further due diligence for things like easement checks, flood checks, inspections, looking at renovation requirements. Actually, is that property going to be value? And then we get it down to typically that one property that's off-market, at the budget, below comparative sales. Then that property goes to our client. So if I'm sort of starting wide and refining it down to saying, what does the actual algorithm and our process spit out as far as that property is concerned? That's kind of that process over a potentially first meeting through to inspections, through to negotiations, through to due diligence, then actually finding the asset.
So you need to know the basic data fundamentals before you can even start looking for a place for someone.
Absolutely.
Because that's going to shape where.
Exactly.
So, and imagine the most important number is how much the house is worth or how much the property is worth, right? That's the key number. That's
the key number, because, it's all good and well us saying, hey, there's plenty of growth markets. I personally bought property in Sydney for my own portfolio in the last couple of months. Now, that property in particular was $2.3 million. Now, am I going to go and recommend that property to that first home buyer? No, there's no point. It's a mute conversation. So, the budget is obviously going to dictate what's possible. If the budget's a lot more, we might also have that discussion and say, do we buy one asset at that higher price, or would you split it across 2, from a $1 million asset as an example to 2 $500,000 assets? That's a part of that same conversation as well. But if I go back to sort of, then we have to understand, well, what are the data points that tell us that market is probably going to be the market that's going to outperform other markets equivalent in that budget? Because it's not that complicated to find a market that fits a $400,000 budget. Our job is to try and find which markets are going to give us above and beyond growth over a shorter period of time. And that's the secret sauce part of us. And I think that's the data part, as opposed to the subjective, we think because it's a great location, good lifestyle, good climate. I could say that about literally thousands of suburbs across Australia. That's not a complicated part of what we do. It's really saying, well, what's going to tell us above all, from a data perspective, what's going to be there? So we've got some things that we've sort of ironed out today to say, here's kind of the main data sets that we look at that's going to give us more confidence in which markets are going to perform better versus the average.
So property data helps you match relatively quickly where you should go fishing for a client.
Yes, mate, it's a good analogy. I think if anyone is, any of the fisher people, the fishermen out there, I guess the analogy is, you've got a fish finder. You see the blips down the bottom. Some of them are real obvious. Others are potentially a bit of rock or a bit of an outcrop, but you don't really know what's there. But it does tell us, realistically, what's going to tell us what's closest to not.
So the point is like if your budget is to buy a house for $500,000, a house with a H, not a property, include like a unit, for example, you're not going to go looking in Sydney. You're not going to go fishing in Sydney for that.
No, absolutely not.
Because
it's a barren wasteland.
Because they just don't exist.
And if you do find it, look, tell me, show me where it is.
Yeah.
I'd be interested. Inquiry at purepropertyinvestment.com if you can show me one. I'm more than happy to look at it. It probably will have a big reason why not. But
this is the point, right? I remember a decade ago when we started investing, like
that was it.
There was plenty of places.
There was.
For and 250 grand, 300 grand.
And that's probably the biggest point here, Matt, is that when we talk about the fact that, hey, it's not in Sydney right now and why data tells us, over the last 10 years, Pure Property Investment as a company has bought in every single major city and state/territory other than Darwin and the Northern Territory. And the reason why I highlight that is that we've bought hundreds and hundreds and hundreds of properties in every one of these markets over time, but we haven't done it ongoing every single year. Yeah. And the reality is the data, typically on a quarterly basis, my team and I do a deep dive into the existing markets we're looking at and then look at that data in other markets and say, is it time to look elsewhere? Is it time to stop buying in this market? And you find that unequivocally over time, we're going from, we've bought lots of property in Sydney, we've bought lots of property in Melbourne, we've bought lots of property in Hobart, we've bought lots of property in Canberra, we've bought lots of property in Adelaide, Perth, you name it. We keep going, Brisbane, but we've never done it continuously over that entire time. And those markets, we go in, we go out, we go in, we go out. And that's where we try to get that above and beyond growth in that shorter period of time. Yeah.
And so it sounds really, really complicated, but when you break it down, it's pretty smart, right? Like you work out where you can buy. What are the baseline factors that's going to shape your buying decisions? How much debt you can get is pretty much, the key thing, and your willingness or attitude towards servicing debt.
Yeah.
And a lot of that will be, do you already own property or don't own property, right? It depends where you start. And is it a formation type of property, which all these things are really important. Now, I think most Australian investors, of which, I don't know, maybe, I can't remember the number, 1 in 8 Australians invest in property or something. I can't remember the number. Only have between 1 or 2 investment properties because they buy the first property is the wrong property.
Yep.
That stops them from buying other properties. So that logic, you've got to get your first one absolutely right, but you've got to start with the data. Just have a sense for where you should be looking for particular assets. Now, there's property data, then there's property data. Most people talk about property data is everything, and which is just really the baseline fundamentals you get on smartpropertyinvestment.com today, which will tell you all the different variables, of how data is mapped and collected. Now, most property data, or all property data largely it's in a review mirror.
Correct.
Right? It's the core logic stuff. When you get it, it's sort of 3 months old, right?
Yeah,
so
a lot of it is.
Yeah, so we're in April now. So CoreLogic's data that they release in April is for January, right? What was happening in January. So it's old. It's 3 months old. That's how long it takes them to get all the sales stuff and work it all out. So if you're investing, looking in your review mirror, you're probably missing out on opportunities for the future. This is a big thing. We do a lot of work on this in Smart Property Investment. Some really cool stuff coming, which you should all know about. Watch this space, how you can invest for the future. But that's one set of property data. Is just like basic fundamentals, which is growth factors, yields, average days on market, how many properties sold. It's all baseline stuff. Other property data is everything else that helps you make decisions, which may be, it can be as micro as, local economy, growth factors, infrastructure spending, population changes, investment in roads and rail. It can be local job data. It can be local economic performance. Like that's a whole nother infinite amount of property data. How do you balance the two of them really well together?
Well, one influences the other most of the time, and that's a pretty easy way to figure it out is that, does it influence it first or does one influence the other second? So you typically find, and if we're going back through our data, that, to your point, mate, with paid data, we pay for a lot of data within Pure Property Investment, and when you pay for data, you get a bit more, and depending how much you pay, you typically get much, much closer to the source. So we typically get weekly data coming back but the weekly data will be on settled data, and a big point on data, why it typically will never be much more accurate unless it's auction clearance rate and auction value, because that's typically sold under auction conditions.
Yeah.
But because a property goes on a contract today, won't settle typically for a minimum 6 weeks, the day that it's actually gone on a contract and the day it's settled, it's only at the day it's settled that actual sale price is recorded. So this is the other big thing too, is that it's pretty hard to figure out how do you get much more accurate than that unless you are literally on the phone to the agent in that area to say, oh, the property's under contract. Do you mind telling me what it actually sold for? And I kid you not, mate, my team every single week make that phone call probably 50 to 70 times.
And that's ground truth, right? That's actually what's happening now.
And that'll tell you, you were asking offers over 520. It went under contract, in the range of 550 to 560 because the vendor didn't want to disclose it, but we know the range as an example. That all of a sudden will tell us, and a lot of the time clients of us will say, all I can see is 6 properties here that are well below the price of that one. Well, here's where you need to understand is that, yes, they'll, potentially some markets will advertise far lower to try and get more activity, and then all of a sudden it goes under contract under a bit of a Dutch auction condition. But I guess going back to your question, we always have to start with the most immediate data because that will tell us what's happening. And if we're talking about the most immediate, typically it's 3-month data will tell us what's happened in the last 3 months. And that rolls together the last 12 weeks, last 3 in particular months, bring them all together and say, here's the last quarter. Last quarter data shows us growth, sideways movement, no growth. That will be your biggest and most obvious precursor to say, is that market growing or not growing?
Yeah.
And if you're not starting there, you need to probably go back to how you're assessing markets and say, if you're not starting there, you need to start there.
Yeah.
And if you're trying to get growth immediately.
Let's chat through some of these data points because they all tell you something, right?
Yeah, absolutely.
They all tell you something. But you mentioned auction data and why everyone obsesses about auction data when it comes out over the weekend, normally reported on a Monday in newspapers, because it gives you a sense of sentiment, immediate sentiment of the weekend just prior, whether or not people are buying, people are selling, whether or not vendors are actually letting properties go and, a sense to how's that compared to expectations around it. So it gives you a health of the market snapshot.
It does. And it depends on which market too, because Sydney, Melbourne in particular, they will dramatically influence the national data because there's typically at least 2 times the amount of properties transacting via auctions in Sydney and Melbourne combined than any other city. Yeah. And the fact of the matter is that if that gets rolled up, then that'll tell a national picture, which is incorrect. So then you need to say, well, how many auctions does Brisbane as a metro have? Adelaide, Perth, Canberra, they have very, very small amounts and they're typically not auction-heavy markets. And a lot of those markets, properties that do go to auction are typically higher price because it's not that actual market that they typically find that from a general standpoint, how they sell property, they're just not used to it unless it's a higher-end property. So that in itself, what it does is it tells you typically sentiment because clearance rates is sentiment in Sydney and Melbourne. Personally speaking, I don't look at as a company, we don't look at, unless we're buying in Sydney or Melbourne, auction clearance rates don't feature necessarily in what we think is a good barometer of where the market's heading forwards or backwards. It does help with sentiment because sentiment typically looks across the country and access to funds, etc., typically will dictate the availability of what's happening from a clearance rate perspective. And if we look at the last 12 months, it's a pretty clear example that Sydney's basically gone up a tiny bit in the last quarter. Auction clearance rates for the first quarter of 2023 were about the same as the first quarter of 2022 as far as the overall auction clearance rates are concerned. And that's quite interesting because it shows that the actual market also in that same time kind of grew a little bit too. If it was declining, you'd typically find that market, 70% typically dictates a slightly growing market.
Yeah. So let's look at some of these data points to help you read the data more effectively and what it all means. Let's go to a break. Stay with us. Back in a moment. Welcome back. Phil Tarrant from Smart Property Investment with Paul Glossop, Pure Property Investment. Now, Paul, we spoke about there being different sorts of property data. So let's just talk about the data that you get on Smart Property Investments. It's called logic-based data. It's baseline data. Back when there used to be property magazines, this was the back 20 or 30 pages where they used to list everything. People would sit there with a ruler and highlight stuff crazy stuff, how people used to interrogate it or they used to buy it purely for the purpose of that data. So you can get it all for free, smartpropertyinvestment.com.au. Now, a lot of people can make assumptions based on data which might not be as appropriate as it should be. So let's just chat through the data points that you'll see on smartpropertyinvestment.com and what it all means. So number sold, Paul. So this is sort of a count of all transactions over the last 12 months. What does that mean? What does it tell you?
So if we talk specifically for houses here.
Yeah, let's just say talk houses.
So if you're going to go and put in a postcode, typically this will be postcode data. And this gets a little bit technical, so I don't want to go too deep into this, but it will talk about SA1 and SA2, which basically means that if there's enough people who live in a particular postcode, it might group together 2 or 3 different markets because there's a number of suburbs which have the same postcode.
Yep.
And what happens typically is instead of saying, I'll look for the suburb, potentially that suburb will also include a couple of different postcodes. So if I look at it, and I'll give an example where I personally know quite well. I live in Cronulla in southern Sydney. Now, Cronulla has 5 suburbs that have the same postcode. So if you look at data for freestanding houses, it's typically classified as an SA2 because it categorises a fair few people. There's about 10,000 different properties there. So if I look at that as an example, when we look at the number of transactions, those number of transactions over the past 12 months will take into account those 5 suburbs that have sold within that postcode freestanding houses. And essentially it means that a property that's gone under contract and is actually settled. And then you can take that 12-month data and you can actually then say, compare that to the previous 12 months, previous 12 months, previous 12 months. And if you look at over a 10-year period, number of transactions is really interesting because number of transactions typically tells you one of 2 things. If it's an established area and there's no new greenfields developments which can skew the data incorrectly, it tells you that sentiment's typically pretty high if its number of sold properties is higher than the average. If it's lower, it typically tells you the opposite, is that you're going to see that sentiment, typically number of transactions for me is a very good indicator, a lead indicator as to sentiment, as opposed to a lot of other things.
Yeah, and careful with the number sold because it can be a good thing and a bad thing. So
correct.
The more sold, you would think, well, it's a more blended view of how a suburb or a postcode is performing, and therefore probably it's more accurate. The inverse of that is that if you have a lot of established stuff, but you've got a whole bunch of greenfield sites, and you see sort of in the Western Fringes now, is if they sell a heap of properties and it's all house and land packages, it's going to skew the data away or difference to established housing. So you've got to be careful. That's where you've got to interrogate. You've got to get in your car and drive out there and go, okay, how's all this make sense? Something's a bit fishy here. Median price, Paul, which is the median sale price of all transactions recorded over the last 12-month period.
And this is probably feeds into your comment just then, Phil, is that this is a big, big part of what people need to be aware, is that you got to find that this is going to be the middle price. And if you're in an area that's got, let's say, I'll go back to my example of Cronulla, you've got beachfront, you've got bayfront, and then you've got suburbs that are essentially just going to be run-of-the-mill streets with no real views or nothing that's going to change it. In any particular quarter or median or 12-month even, you can get in that particular location, get a $25 million waterfront, sell at the same time as a $1.7 million freestanding house. Now, if you're looking at that in too much of a shorter term time frame, then that data will look very skewed. But if you go to 12 months and you're getting hundreds, if not thousands of sales, then that will smooth out that line. And this is where it comes, sometimes looking at longer term data as opposed to shorter term data tells you a better, more predictable story. But I think to your other point there about the greenfields locations, you can find, and there's no shortage of them, every single major city will have them in these areas which Stockland have bought up, or any of these other major developers who go through the civils and then right through to releasing land and selling house and land packages. You might find that in the same suburb, all of a sudden you've got a $700,000 sale, which looks like a complete breakout quarter or a breakout year, and all these prices have gone up. But as it turns out, there's been 350 brand new house and land packages that have sold $300,000 above the median 12 months. That is in the same area that you've got established 70-year-old red bricks that are in the same market on the same size land. All of a sudden you think that market's boomed or is booming, and you'll get a lot of people sell you that sizzle there where you think, hey, you've got to get in now because look at this data. To your point, you've got to get there, you've got to see it. And I can almost guarantee that if you are seeing that type of data presented in front of you by someone who's trying to influence you to buy something brand new or off the plan, please interrogate that information a little bit differently and make your own decision.
Always a story behind the data. You sort of referenced this very quickly, Paul, which is the median quarterly growth, which is the percentage change in the median sale price in the same period compared to 3 months ago.
And that's a big one. I think for us, that's a really, really big influencer because if you're, again, and I'll use an example of an established suburb as opposed to brand new because they are always going to be a little bit more funky as far as where and how that information comes out. But if you're essentially seeing over a 12-month period, the last quarter grew by 4%, previous quarter, for example, grew by 2%, previous quarter was flat, previous quarter was flat, you start to get a pretty clear picture from an influence, as long as the number of sales is high enough and you're not looking at a really, really small market or a market that's got hugely influential different prices that can be really expensive or really cheap. If you're looking at a very run-of-the-mill suburb where it's got very comparable areas and you're seeing an actual quarterly change that's increasing positively or negatively, that's going to tell you a lot of the headline data is to say, here's what to expect. Don't look at it in isolation, though. You need to draw it out to the previous 2, 3, 4, 5, 6, 7, 8 quarters, because it starts to tell you a very, very interesting and clear picture.
And then you've got 12-month growth, which is the percentage change in the median sale price in the same period compared to 12 months ago. So you've got to be careful with this. If you do 4 lots of quarterly growths, it's going to tell you a different sort of picture to 12-month aggregate data.
Exactly.
It's what it's comparing against.
Yeah, exactly, mate. And it's comparing to the previous 12 months. And that's exactly right, where you've got to look at it in 2 sets of information to say, look at quarterly growth and compare it to previous quarters. But if you're looking at 12-month growth, comparing it to previous 12 months, that's the information that is actually going to potentially look completely different. But if you start to overlay the two to say, if you've got a market that was potentially flat for the last 12 months compared to previous 12 months and so on and so forth, but all of a sudden you're seeing some green shoots of back-to-back quarterly growth, that might be a very, very clear and obvious indicator to say, hey, this market's just starting to actually move.
And this is why you've got to compare that again with other data points. And you have 3-year growth and 5-year growth. So, comparisons around, you've had very little growth over 12 months, but you're starting to see 3-month growth. If you go back and compare that against 3-year and 5-year growth, and 3-year growth is a percentage change in the median sale price in the same period compared to 3 years ago, and 5 years compared to 5 years ago. So again, it's another point of overlay.
Absolutely. And this is where, if you're sort of looking at that hockey stick location, or the hockey stick graph rather, and trying to say, okay, well, am I sort of trying to really drag out numbers over a bit more of a consecutive period to say, well, I want to see the bigger picture. I want to zoom out, because sometimes people just think, okay, 3-month growth, it's growing, fantastic. That gives me confidence to say the next 3 months, or it's at the start of a boom. But if you zoom out for a second here and say, over the last 5 years, that market actually saw 40% growth up until 2022, flattened out. And then now that last 3-month growth, or that last quarter, we're just seeing growth again, and you haven't looked at that 5-year picture or even that 10-year picture as an example, you might actually be rudely shocked to say, hey, hang on a second, you're still buying into a market that's seen 50% growth in the last 5 years. Yes, it saw some more immediate growth, but you need to take into account that 3-year position, that 5-year position, because I'll give you a number of markets that are sort of quite interesting. If you looked at it from a quarterly perspective, you might say, hang on a second, Sydney, for example, looks like value because it's just starting to grow and it went backwards 15%. If you zoom out to 3 years, well, hey, Sydney's still up, in some cases 15 to 25% over the last 3 years. If you zoom out 5 years, you might say, hey, some of those markets are up 40 to 70% in the last 5 years. Yes, they went backwards. They gave back 15% and they've grown the last quarter. Is that telling me that the market's about to boom? Well, if you look at that 5-year data, you might not necessarily be as confident, but then you compare it to markets such as, let's say, for instance, Hobart, or markets such as Adelaide, which have absolutely boomed in the last 3 years, might still be showing some growth on a quarterly basis, but is that market actually growing at the same propensity, or is it actually reducing? That's where it starts to become very, very interesting. So you need to say, well, what's expected to happen over the next 3 to 5 years, as opposed to what's actually happened over the previous 3 to 5 years. And that's the big part that we always have to consider.
And this is why average annual growth, and this is a key one, which is the average annual growth of a suburb each year over a 10-year period. I like the 10-year average annual growth. It tells you how it's performed on average every year.
Absolutely. And I guess one of the biggest struggles we have at Pure Property Investment is sometimes when we get to the point of going through a strategy and allocating a particular amount of suburbs, and then eventually securing a particular property and then showing all the data to our clients, that 10-year growth in a lot of times might say, hey, look, that market saw extreme growth, for example, between 2013 and 2016, and then went flat for a long period of time. In some cases, we might be looking at markets that have gone flat between potentially 3 and 6 years and had very, very incremental growth. But in that same time, we're starting to now see other things starting to influence it, like higher levels of population growth, lower levels of supply, lower levels of vacancy rates, and all of a sudden now we're starting to see more recent 2-month, 3-month, 6-month, 12-month growth. And you have to be confident that just because a market hasn't grown in the last 5 years or 10 years, that it isn't going to grow in the next 5, 10 years. So sometimes it's a little bit counterintuitive that people think, oh, it hasn't done anything in 5 years, so I don't want to buy it. They're the reasons a lot of the time why we say that is the reason why there is value in these markets. And I'll give an example, Perth right now. A lot of people get very spooked with the data in Perth. If you look at it from a 10-year perspective, if you bought property in Perth 10 years ago, you would be very upset with the performance up until the last 2 or 3 years. Pretty much the same as Brisbane, mate. I remember being on this podcast with you talking to no ends about market in Brisbane, we've bought a lot of property in the Southeast Queensland corridor, and there would have been 3 or 4 years where you would have looked at your property data and thought,
"Oh, come on,
it's due. Surely something's going to happen." But the reality is, the data didn't show anything was going to happen until it actually started to show it was going to happen. It showed that it was cheap, but it's comparing it to what's it cheap compared to. Eventually, it came good. What you probably didn't do in Brisbane is you didn't overpay. And that's the bigger risk for anyone who's trying to buy in a market that shows a really strong 10-year growth. And they think, okay, I'll buy now because the last 10 years was amazingly strong and it got 130% growth. I'm expecting to get another 130% growth. If that's your reasoning and rationale, that is where you're going to come unstuck because you're not looking at the other data points.
Yeah, and it's often a good reason why something hasn't grown in 10 years, right?
Yeah.
And if you see that, query it, interrogate it. Brisbane, a little bit different. Perth, different. Again, it's got no dynamics, but some mining towns, negative,
small
negative
population.
Growth. Yeah, and just because it hasn't grown in 10 years doesn't mean it's going to grow. It's probably a good chance it won't. So
correct.
There's still places you can buy. You can buy houses in Australia for still like $30,000.
Absolutely.
Right? Yeah, they're out there.
They exist actually in a lot of places. Yeah. No doubt. And are we lining up to buy them? Absolutely not.
No. Weekly median advertised rent, which is in dollars, the median value of advertised weekly rent captured during the last 12 months. What's this one? Tell us.
And this one, anyone who's going to jump on your data on smartpropertyinvestment.com.au is going to see that this is a really interesting one because it's a lot more immediate because it tells you a picture of what's happening in the state of the rental market. And I guess going back, it probably also overlays the value as well as the demand for people who are buying property versus renting property. Now we're seeing this influence of this interstate and overseas migration in particular that we've now started to see over the last 12 months. This tells us more than anything else what people are prepared to pay for that equivalent property over the previous 12 months, And if you're looking at data over the last 1 year versus last 3 years, 5 years, 10 years, you will very distinctly see this ridiculous uptick in almost every single major metro market, in a lot of cases some regional markets as well, because there's two things. There's too much demand for the supply that's available out there, and the price of money has essentially influenced people who are potentially wanting to buy in those markets, can't afford to get the funding, so all of a sudden are pushed into that rental market.
Okay, what's time on market mean? That's in days. So there's a median number of days it has taken to sell those properties sold by private treaty during the last 12 months. So it's not auction, it's private treaty.
Yeah, private treaty, correct. And this is one that you will find is actually a really good historical data point if you're looking at this over a longer term period. I like to look at, if I'm looking at specifically time on market, if a property is taken, I'll give you a good example. There's a suburb or a region, the Upper Hunter of Muswellbrook. Now, that was a market that was highly influenced and still is highly influenced by mining, particularly coal. That market's gone through boom and bust about 4 or 5 times over the last 20 years. It's only about an hour and a half from Newcastle, and it's only about 3 hours from Sydney. You think, okay, it's not too far from everything. It should get a flow on. Kind of does, kind of doesn't. But what it does have is it has a really interesting chart. If you go look at median days on market, is that you will see sometimes that it's gone from a median days on market of 10 to 15 days right up to 180 days. And that's over a 10-year period and typically over 3 or 12-month blocks. And that essentially is a direct measure on the actual demand in that market for people wanting to buy property. Now, that's an extreme. If you go to markets like, draw any postcode in the Sydney Metro, Melbourne Metro, Brisbane Metro, etc., you'll find that it smooths out a lot more. But over the long term, the trend will always tell you if that days on market is increasing and you're also seeing things like 3-month growth is flat or negative, 12-month growth is flat or negative, that probably tells you very, very quickly to say the demand is not there. And if it's still increasing, that tells me that market's going to get worse before it gets better. If you're on the opposite end and you're seeing that the 3-year trend on days on market is coming down and the actual 3-month growth is positive, 12-month growth is still slightly positive, and you're seeing things like vacancy rates and rental increases, that tells you there's a little ecosystem there of high demand for renters, high demand for owner-occupiers. There's actually more demand than there has been the previous 3 years, which probably also tells you that there's less supply coming into that market. So there's more people fighting for less property, and that bodes well for prices on both capital growth and on rental growth. And that for me is a very key secret sauce for anyone who's wanting to understand how to get into a market that's going to grow quicker than other markets.
Well, there you got it. You got it there. You're going to turn that into a YouTube clip, no doubt.
Right there.
All right, final one, Paul, is gross rental yield, which is the indicative gross rental yield provides a guide about the gross rental return achieved during the last 12 months. It is calculated at the essentially it's annualized, which is median asking rent times 52 weeks divided by the sales price gives you a yield. There's a whole bunch of different ways you can measure this.
There is, mate. And I think it's very interesting because, in the last 3 years, you've actually gone from yields falling off a cliff. The actual, if you compare it, we talk about yield there, the previous one was talking about the actual rental value amount. Yeah. The reality is just because yields don't go down, that doesn't mean the actual value of rent's gone down. A yield is an actual direct comparable to sale prices. So when markets go berserk as far as capital growth is concerned, you'll typically find that yields look terrible and they look worse and worse. They go opposite ways if we're looking at it from a graphical representation. And we go through this market that we have in the last 12 months where prices have plateaued, if not come down. And that typically means that there's more people moving to the rental market, less supply. Now we're seeing the opposite of that happen. So when markets go backwards, rents typically yield from a yield perspective, they go up. But then also you've got to temper that with saying, well, what's the cost of money in that same time? So right now, obviously, we've gone through an increase in cost of money. Just because the gross yield looks good at 6%, is that actually good historically? Then drawing out, and you can get some really good data. I mean, we buy a lot of data that tells us what the gross rental yield has been over not only a 3-month, 12-month, but all the way out to 10-year representation. And that tells you the actual percentage of gross rental yield, as well as the actual value of rent at the same time.
Yeah, just be careful with yields because if you see people selling properties on the basis of yield, it's normally a bit of a red flag for me. They go, this got a yield of 7%, and then when you add your tax incentives, it's whatever,
that's scary.
The baseline measurement of rental yield is against the purchase price, right? Like I measure yield against establishment costs, right, which is also stamp duty and legals and all that sort of stuff. You can measure it against the current valuation of the property rather than the sale price, right? That gives you a sense of your rent today versus the actual value of the property today rather than
what you pay for it or what your debt profile is on the property, etc.
Yeah, there's a whole bunch of different ways you can slice and dice it. Don't get too absorbed or obsessed by it because it can mean many different things. But Paul, some secret sauce there. Thank you.
Mate, there certainly is. And I think if anyone's trying to sort of capture a list, that what we've just gone through there is a really, really clear sort of point form to say, if you're wanting to do it yourself, here's what you need to focus on first and foremost. And I think we touched on at the start of the podcast, mate, is that it's not only sort of going through this to then establish which markets are going to fit that profile, but when it comes down to it, I could explain to, and I do, when clients catch up with me for the first time, what I typically will provide out of that is a strategy. And out of that strategy, I will typically tell them, without paying them any money for that matter, I will tell them saying, here's your budget, here's what we're trying to achieve, here's what else you have in your portfolio. We will break down, here's probably half a dozen to a dozen suburbs which we expect will fit that. And I give that away for free. So if anyone wants to actually catch up with me and then go through that conversation, purepropertyinvestment.com, they can click inquire now, book in a time to have that conversation with me. But the reason why I'm happy to give that away is because if someone wants to go do it themselves, I know what happens after that. And what happens after that is hundreds and hundreds and hundreds of hours of inspections, negotiations, and looking at comparable sales, looking at due diligence, looking at orientation of land, looking at the zoning of that particular land, looking at the utility, looking at things like flood overlays, bushfire overlays, looking at cash flow breakdowns, looking at the condition of the property. They're the things that take us as buyers agents who are going to get the absolute best result. That's what takes us more time than anything else. And we are absolutely paramount in the sense of that's what we focus on. We can get the data and we can say, here's what will make sense. But it comes down to, you've got the ASX 200, mate. If you bought the ASX 200, i.e. in an ETF, then you'll get the average. If you buy one particular stock in that, that's going to outperform it. Our job is to typically try and find that one higher performing company in that actual ASX 200 equivalent.
So what Paul's talking about there is execution. It's you might know what you need to do. It's how you go about doing it. It's a tough bit. And it's where most people get fatigued as well, where they sit there and they've done it for 2-3 months going,
it's exhausting.
I can't do it. I probably just keep going for more than what I expect to pay, et cetera, et cetera. So some really good insights from Paul. Where they got to go if they want to have a chat with you?
Purepropertyinvestment.com, or they can simply shoot me an email, inquiry, ENQUIRY, at purepropertyinvestment.com. We can set up a time to chat anytime.
There you go. All right. Thank you, Paul. Really insightful. And it's good. You've got to be informed and educated around these type of points if you're going to be serious about investing in property. There's a whole bunch more info, smartpropertyinvestment.com.au, and go and have a play with the Suburb Search app as well. you get all this data for free. Go and check it out. Again, much like what Paul's saying, can tell you something. It's what you do about it is the important bit. Remember, Smart Property has you on social media is where you'll find us, smartpropertyinvestment.com.au. If you want to come over chat on the podcast, got any questions, editor@smartpropertyinvestment.com.au. The team will pick it up and we'll get them answered. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you looking for a new challenge that combines your existing skills with the exciting world of mortgage broking? Well, listen up, because we've got the perfect opportunity for you. Introducing the Advisors New Broker Academy 2023, a free event designed for professionals just like you who want to learn how to become a trusted broker for their clients. Coming to Brisbane, Melbourne and Sydney in June, you'll learn from industry specialists and gain crucial industry insights and intelligence to become a go-to broker. You'll also have the opportunity to network with brokers at all levels and gain a competitive edge in the marketplace. Register now for free at newbrokeracademy.com.au and join the top brokers of tomorrow.